Hello and welcome to Pro Trader Strategies Market Commentary for Wednesday the 16th. My name is Eric Wilkinson, and yes, you very well may recognize me as Wolfman from mainstream media, where I've talked about the economic data, the geopolitical environment, how that comes in to impact the markets with my market analysis. And I do the same thing in these daily market commentaries, but I'm going to go a little bit further for you guys out there and talk about the strategies, the option strategies, and the trades that I'm putting on a daily basis so that I can give you guys some insight into how you should really be trading these options. It's not going out there and having an assumption and just picking a strategy out of the hat. No, what we do is we really drill down on the details of these option strategies so that you guys can increase your probabilities of success. Yes, there's a right time and place for a certain strategy, so I'm going to give you guys an open window into how to trade those types of products. All right, so without further ado, let's get on with the economic data and talk about across the pond. Not really a whole lot going on there. One thing to keep in mind that I might forget about, it's the second day of the FOMC economic meeting. So what's going to come out of that? Well, probably nothing, but something to note that's been happening around the globe right now is we're seeing interest rates really come off a bit. As a matter of fact, Germany is really toggling between a real all-time low there. If it settles below negative 50 basis points, that will be historical. We're talking negative rates there, you guys. Here in the United States, we're talking about really suppressed interest rates, tenths of, 10 basis points or so. I don't think that the Fed's going to do anything. One thing also driving the markets today, we've seen the dollars get a little bit of strength. It's starting to weaken a little bit ahead of a lot of news around this next stimulus package. Pelosi basically saying that people need to stick around and they're going to have to come up with a stimulus package. It's still going to be a big debate, and I don't know when it's going to come out, but it looks like it's starting to come to fruition. So that could weaken the dollar. That is ultimately going to push the stock market higher. That is based on forward expectations that there's going to be velocity of money around the corner again as we're starting to see this V-shaped recovery work through. All right, so more economic data. Business inventory is coming off just a little bit, 0.1%, expected to be 0.2%. That's kind of following in line with what we've seen through most of the economic data, although we did get core retail sales today, which is stripping out food and energy, or excluding automobiles, which is more volatile aspect of the retail sales. That came in at 0.7%, expected to be 1% when we add back in retail autos to the retail sales number. Came in at 0.6%, expected to be 1.1%. So while we were seeing that spike in retail sales for a little while there during the pandemic, that people were wanting to go out there and get a car and not take public transportation, not take an Uber anymore, well, that whole thing seems to be waning a little bit now. So business inventories coming off a little bit, but not really showing up in those core retail sales like we'd like to see. Now, we did get a good economic data point out of the NAHB, which is the National Association of Home Builders housing index. Came in at 83. These numbers are basically all-time highs, you guys, knocking it out of the park again, where with these suppressed interest rates, people getting some stimulus checks, they're probably putting some of that towards a new home, maybe. Well, a lot of people out there looking for a new house. And part of this is, that urban sprawl where people that were living in the cities are getting out into the suburbs and buying a house. Well, we're seeing those rentals in New York City like plummet. All-time lows on rentals and vacancies, or lack of rentals, and the vacancies spiking there. And remember, we do have the Fed interest rate decision later on today. All right, so in about an hour and a half. So hopefully I'll get this out to you before then. All right, we've got crude oil back into the 40s. Good thing I just filled up yesterday. And we've got it back up into the 40s. It looks like we are going to be looking at over $2 a gallon at the pump. A lot of this is going to be with the fact that the market looks like it's getting a little bit happy about the way that this economy is turning around after the pandemic. All right, so gold futures moving a little bit higher on that expectation that we're going to see some weakness in the dollar. And with that being said, you know, the round of the stimulus package weakening the dollar and causing a product like gold futures, which is dollar denominated, to move higher. Bonds creeping up a little bit, back above that Fibonacci I've been talking about. I think we're going to see some more strength here in the bonds, especially after the FOMC. I think that that's going to signal there is nothing doing, and that the interest rates aren't going anywhere anytime soon. VIX is slightly in negative territory, but we could call it unchanged as we have pretty much a mixed bag across the board. We're seeing the Dow Jones Industrial Average get some strength here, up 190 points on the day and very near the high, while we're seeing the NASDAQ continue to slide and very near the lows. Now, the tech sector is the one that we've talked about, has been a little bit frothy, maybe gotten a little ahead of itself, and that we're going to see some sector rotation here going on. And I think that's what we're continuing to see. Anybody that has been involved in this run-up, especially if you got involved early on in this rally back in March, well, you have to be thinking it's time to look for some value there and roll it, re-diversify your portfolio, because you don't want to be well overweighted tech. Even if you got involved in March and you had some tech and you were equally balanced between tech and like blue chips and staples and stuff like that, well, this tech sector has had that massive rally, and now we've seen some of these big tech guys do these stock splits. Well, that means that now you're you have more allocation in a sense in stock to those certain sectors as they ran up, even based on those splits, is kind of where I'm going with that. Not necessarily that you got 5 shares for every one. No, I mean, well, what it means is that that value of those shares and that portfolio section over there is really weighted towards tech. And that's volatile. That's one of the most volatile sectors of the overall equity markets, all right? And we talk about that in the daily market commentary, in the webinars more so. We're talking about where I compare volatility between some of the staples and some say, Microsoft, or especially Tesla, where those volatility coefficients are much higher. Now, does that mean, I'm not going to go all into that, but you guys get my drift there. That is the more volatile section of your portfolio. So when you start seeing that weighting towards that, you need to start reallocating some of that. I think that that's what the broader markets are kind of starting to do at this point, as we're seeing the E-mini S&Ps slightly in positive territory. They're not getting a big boost to the upside, but one thing to note is it's above that 9-day moving average. We've talked about it bumping up against that yesterday. It landed right on that. Today we're getting that move higher. It's still finding some resistance at the value area there, but we are starting to see that sector rotation. I think it's going to give it a little bit of push. I expect us, aside from the Fed really coming out and throwing a crater on this market, I think that really what they have to say today is going to give the overall markets a boost. I think that they're going to be very dovish, if you will, on interest rates. Now let's take a look at the E-mini S&Ps. As tight of a day as yesterday was between the value areas, it is completely lined up today. Almost a perfect mirror, really, to be honest, as an inside day. Like I said yesterday, people were going to be shoring up positions. They're not going to be making a whole lot of volatility ahead of this FOMC. Today is even more so a representation of that, where people don't want to put on a ton of risk right before this binary event, right? FOMC meetings are binary events, all right? So we're seeing that in the equities today. It's not just about the interest rates, seeing some of that binary event stuff. All right, so let's talk about some trades that I've done. Yeah, this one was a dud, right? Got out of this trade rather quickly, and Kellogg. I still have on the Coca-Cola, or sorry, I still have on the Kraft, but out of the Kellogg, it broke below that Fibonacci. You can see we got some nice support there, which is what I was expecting, and get a little bit of a rebound. I talked about this as, I think more and more people are going to eat breakfast at home before taking off, like old school. Since the pandemic, that's been a big deal. I thought that kind of would continue going forward as people are trying to, think maybe more healthy and, yes, go out for lunch and maybe dinner. But I thought that the stay at home the eating at home breakfast would kind of stick. The markets don't think so much. So with that said, I basically got out of this trade rather quickly. I mean, I've only had it on for 2 days. I put it on the 14th. Looked like we were getting some support here. And then yesterday I stuck with it despite the fact that we did break below a little bit on that Fibonacci, but stayed above it. And it was looking pretty strong today, basically. We threw the baby out with the bathwater, and they started selling off. So I decided to pull the ripcord because I talked about it. Breaking below that is going to be a no-go on this trade. So in this, I went into the D's, if you guys remember, and bought the 67.5 calls in there for $2.45. I dumped them out for $1.85 today. So a little bit of a loser there. I took that out of my trading account and my IRA. So out of those trades, out of that trade there in Kellogg. Still have on the Kraft, or the Kroger. That's still going to give me exposure to that. I think more and more people are going to try and eat from home rather than necessarily go out, because we still don't have restaurants coming up. In New York, I don't even know if they've actually started allowing indoor dining and stuff like that. Well, we're heading into fall. Who wants to sit outside in the rain and the snow? All right, so Coca-Cola, if you guys remember, I've had this trade on since basically the pandemic, where I was selling March 53 puts in there back in the day. Well, I got those stocks put to me. I still believe in this stock. It is part of that reopening trade. More and more of their sales come from the bars, restaurants, and stuff like that. And when people are going there, they're obviously not doing as many sales. Some people are still buying it at home, but like I said, the majority of their sales comes from the restaurant industry. So back in the day, I had sold those March 53 puts that ended up getting put to me. So I'm long the stock at 53, and I've collected some credits. I sold some 30 puts in there. I had sold some 50 calls in there, and then 43 puts twice, two separate occasions. So I've overall lowered my cost basis in this trade by almost, $2 really, if you add up all of the stuff. But I started looking at it the other day, and I forgot that some of those trades I had put on for about half. Like when I was selling the 30 puts in there, I had only done it about a half a tranche in there. So really, I'm going to call it, I've lowered my cost basis totally by about $1.45-ish. Not quite what I thought originally, but anyway, $1.45. I'm long at 53. You can see that is very close to break even right now. So staying diligent, staying mechanical with this trade, lowering the overall cost basis on that has allowed me to stay in the game quite nicely, and just increasing my overall yield, right? I mean, if I would just be long at 53, well, I'm long at 53, nothing's happened. Well, I've gotten the dividend, right? That's one couple of nice things. I've got a couple of dividends since I've put this trade on. We could say that that's lowering my overall cost basis, but I'm not going to call it that necessarily. But with this extra $1.40, that's an extra dividend I've gotten in between all these other dividends. You could look at it as well, right? I mean, I'm still long at 53. That's what's showing up in my P&L, but I've gotten all these extra dividends, I mean, if I consider those drips, reinvesting, I can reinvest that money somewhere else. So all of those things being equal, that's how we do it. All right, so without further ado, let's move on, because I do want to talk about one other thing, is snow. because Snow is the IPO. That's a great chart for Snow, looking at the candle over here. So opened up at 245, looking at 276 right now. This is 70 times forward earnings. 70 times forward earnings, people. Now, if you don't know what Snow is, or Snowflake, Snowflake is in the software business. They are cloud-based for the most part. So they are basically going to be competing with AWS, which is Amazon Web Services, and Azure, which is Microsoft Web Services, cloud services, okay? So they are basically in that space there. Great for a consumer, especially if you're building a website or something like that, that this competition of these juggernauts is actually going to help us with pricing, right? Because now we have more and more people in the space that can compete and lower the overall prices for the rest of us, as you can basically now have several people to pick from. So 70 times forward earnings. This launch basically coming out, it started out like at the beginning of September, looking like $85 a share, and then yesterday or the day before that, it was looking at $140 a share. Well, today, opening up at $245. Berkshire Hathaway involved in this, and you know that's what's helped to get a lot of publicity on this whole opening. So they are just crushing it today. This marks Snowflake as being the largest software IPO ever. I mean, bigger than when anybody else has come out with their software. So that's just crazy to think of that. But 70, yeah, it's probably well over 70 times forward earnings at this price. I think I was judging that on the $240 opening. But Snowflake just crushing it today. Any early investors in that are very happy today. As like we talked about, starting out at $85 a share just a couple of weeks ago, people were probably pretty happy about that. Today, $280. All right, so that's all I've got for you guys today. Tomorrow's webinar, we're going to be doing it on the Long Iron Condor. I'm going to show you when, where, and why we would want to set that up and how that impacts your overall portfolio. Also, tomorrow it's a double dinger. I'm going to be working with Steve Bigelow on a candlestick webinar there, and I'm going to be talking about some floor trader hacks that I haven't really talked about in quite a long time, so please check that out. Follow us on Facebook, Twitter, at Pro Trader Strategies. You can follow me also, so you can get that link there for that webinar. All right, that's all I got for you guys, other than one other thing. Other than, take a moment to go over the disclaimer. We're an educational company. If you can't, I missed twice. If you can't take that, take it easy.